$600 trillion. That's the notional value of the global derivatives market. The entire world economy is 100 trillion in annual GDP. Everything produced, every service rendered, every transaction in every country. The derivatives market is 6 times larger than that. It's not wealth, not assets, not money that exists. It's bets, contracts, promises to pay based on underlying assets that are worth far less. It's leverage piled on leverage again. And it's sitting on the balance sheets of every major bank, interconnected through chains of counterparty obligations that nobody fully understands, that no regulator can map, that no stress test captures, because the moment you try to unwind it, the moment one major institution fails, the entire network collapses. This isn't theory. It happened in 2008 with the derivatives market half this size. AIG collapsed under credit default swaps. Lehman Brothers evaporated overnight. Bear Stearns disappeared in days. The government spent trillions bailing out banks that were too big to fail, too interconnected, too exposed to derivatives. And today, 15 years later, the market is twice as large, the banks are bigger, the interconnections deeper, the leverage higher, and the regulators have given up. Because the derivatives market isn't designed to be safe, it's designed to be profitable for banks until it's not, and then it's catastrophic for everyone. A derivative is simple. Conceptually, it's a contract whose value derives from an underlying asset like a stock, a bond, a commodity, a currency, or an interest rate. The derivative isn't the asset itself. It's a bet on the asset's future price. Futures, contracts, options, swaps, forwards. Each type serves a purpose originally. Farmers used futures to lock in prices for crops before harvest. Airlines used them for fuel costs. Manufacturers for raw materials. It was hedging, legitimate risk management, transferring price risk from those who couldn't bear it to those who would for a fee. And that was fine when derivatives were tied to real economic activity, when they were transparent, traded on exchanges with margin requirements and clearinghouses. But then derivatives moved off exchange into darkness. Over-the-counter bilateral contracts between banks with no oversight, no transparency, no capital requirements, no limits. And volume exploded from trillions to tens of trillions to hundreds of trillions in 2 decades, not because real hedging grew, but because banks discovered derivatives were profitable, extremely profitable, and almost completely unregulated. The Commodity Futures Modernization Act of 2000 was the trigger. Signed by President Clinton with bipartisan support, pushed by Treasury Secretary Larry Summers and Fed Chairman Alan Greenspan, the law said derivatives, specifically credit default swaps, could not be regulated as insurance, could not be regulated by the CFTC, could not be regulated by the SEC, could not be regulated by anyone. It created a regulatory black hole, and Wall Street flooded into it. Banks started writing credit default swaps on everything: corporate bonds, mortgage-backed securities, other derivatives. It was insurance against default. You buy a bond, worried it might default, buy a CDS. And if the bond defaults, the CDS seller pays you. Sounds reasonable, except the law didn't require CD sellers to hold capital against potential payouts. Didn't. Required them to be insurance companies with reserves. Didn't limit how many CDs they could sell on the same underlying asset. So AIG sold hundreds of billions in credit default swaps on mortgage securities with almost no capital backing the contracts. When mortgages defaulted, AIG owed more than it had by magnitudes and couldn't pay. The counterparties were every major bank on Wall Street. If AIG failed, they all failed. So the government bailed out AIG with $182 billion. Not to save AIG, but to save the bank's ego. It was a backdoor bailout of Wall Street through AIG, and the public never fully understood that the crisis wasn't just mortgages. It was derivatives built on mortgages that multiplied the losses by orders of magnitude. If you're starting to understand that 600 trillion in derivatives sits on bank balance sheets, that it's interconnected, that regulators can't map it, that it caused 2008 and it's twice as large now, then you need to see what comes next. Subscribe now, because the mechanics of how this collapses, the triggers, the contagion paths, the inevitability of the next crisis are about to be revealed. This isn't speculation. It's mathematics. It's network theory. It's historical pattern repeating because nothing fundamentally changed. The banks are still too big, still too leveraged, still too interconnected through derivatives that nobody fully understands. And the moment you understand how fragile this system is, you'll never look at your bank account the same way again. Lehman Brothers had 13 trillion in notional value of derivatives on its books when it collapsed in September 2008. The bank's actual assets were 600 billion, the derivatives were 20 times larger. Lehman was counterparty to thousands of contracts with hundreds of institutions. When it failed, those contracts became worthless or disputed or impossible to settle. The institutions on the other side had hedged using Lehman. Now the hedges were gone, but their exposures remained, so they scrambled to replace hedges in a panicking market. Prices located, liquidity disappeared. Other institutions, seeing chaos, stopped trading with anyone whose solvency was questioned, and credit froze globally. Not because underlying assets were worthless, but because derivatives created that transmitted one failure into universal panic. The system wasn't just exposed to mortgage losses, it was exposed to counterparty risk across the entire derivatives network. And that network was 600 trillion even then. Lehman was just one node. Its 13 trillion represented 2% of the global market, and it brought down the system. What happens when 3% fails? 5%? 10%? The answer is nobody knows because the interconnections are too complex, too opaque, too model. The banks themselves don't know their full exposure. They know their direct counterparties, but not their counterparties. Counterparties, not the chains that connect them to every other institution through degrees of separation that multiply exponentially. Bear Stearns collapsed first in March 2008 with 13.4 trillion in notional derivatives. The Fed forced JP Morgan to buy it for pennies with 29 billion in Fed guarantees against Bear's toxic assets. Why? Because letting Bear fail would trigger derivative contract failures across the system. 6 months later, they let Lehman fail, thought the system could absorb it. They were wrong. Within days, the global financial system was hours from complete collapse. Money market funds broke the buck. Commercial paper markets froze. Overnight lending stopped. Companies couldn't make payroll. The Fed had to create emergency facilities lending trillions to prevent total meltdown, and the derivatives market was the transmission mechanism. Not the cause. The cause was bad mortgages, but derivatives amplified it from a housing problem into an existential financial crisis because the exposures were hidden, the connections unknown, the leverage extreme, and the moment confidence broke, everything unwound simultaneously, unstoppably, catastrophically. Dodd-Frank was passed in 2010 to prevent the next crisis. It required derivatives to be cleared through central clearinghouses, required margin posted, required reporting to regulators, required banks to spin off derivatives trading into separate subsidiaries. The Volcker rule banned proprietary trading and limited derivatives risk. It looked comprehensive, looked like reform, looked like the system was fixed. It wasn't. The banks lobbied extensively, delayed implementation, watered down rules, carved out exceptions. By 2017, most of Dodd-Frank was effectively neutered. The clearinghouse requirement applies only to standardized derivatives, but most derivatives aren't standardized. They're bespoke, customized, bilateral, still over-the-counter, still opaque. The margin requirements are calculated using banks' own models that underestimate risk. The reporting goes to regulators who don't publish it, don't synthesize it, don't have tools to analyze system-wide exposure. The Volcker rule was weakened repeatedly until proprietary trading is effectively allowed under different names like market-making hedging and liquidity provision, all exemptions that banks drive trucks through. And the separate subsidiary requirement was delayed, then abandoned. Derivatives remain on bank balance sheets, backstopped by federal deposit insurance, guaranteed by taxpayers who don't even know they're exposed. The Bank for International Settlements tracks this and publishes data twice annually on global derivatives. The notional value as of mid-2023 was approximately $6 trillion. That's the face value of all contracts outstanding. The gross market value is lower, around 20 trillion, which is the replacement cost if all contracts settled today at market prices. Banks say, look, 20 trillion, not 635 trillion. The exposure isn't as large as notional implies. And they're technically correct, but misleading, because gross market value assumes orderly settlement, assumes markets function, assumes counterparties pay. In a crisis, none of that holds. Markets dislocate, prices gap, counterparties default, and the notional value becomes relevant again because contracts meant to offset don't offset when one side doesn't pay. The hedges fail, the exposures are naked, and suddenly that 600 trillion in contracts becomes 600 trillion in obligations that can't be met by anyone. The netting assumptions that reduce reported exposure collapse the moment confidence breaks. And we're back to 2008, except larger, more complex, more leveraged. more interconnected, less regulated than before. Do you see the trap? The system was built to privatize profits from derivatives trading while socializing losses through bailouts. Banks collect fees, spreads, and trading gains while markets function, while confidence holds, while counterparties pay. But the moment something breaks, the losses are catastrophic and fall on taxpayers who rescue too big to fail institutions that are even bigger than in 2008. JP Morgan Chase has 60 trillion in notional derivatives, Bank of America 30 trillion, Citigroup 48 trillion, Goldman Sachs 41 trillion. These four banks hold 179 trillion in derivatives combined. That's twice the global GDP held by four American institutions that are backstopped by the FDIC, guaranteed by the Treasury, protected by the Federal Reserve because they're too big to fail, too interconnected, too important to the payment system, to the credit markets, to the economy to be allowed to collapse. So they operate with implicit guarantee, take massive risks knowing they'll be rescued. It's moral hazard, institutionalized, permanent, unresolvable, because the alternative is letting them fail and watching the entire system implode. The five largest US banks hold 95% of all derivatives in the banking system. Concentration isn't just high, it's absolute. And those five banks are all counterparties to each other. JP Morgan owes Citi owes Bank of America owes Goldman owes JP Morgan, Wells Fargo somewhere in there. It's circular, self-referential, impossible to unwind without everyone failing simultaneously. This is called too interconnected to fail, even worse than too big to fail. Because size you can break up, but interconnection you can't sever without destroying the network that makes modern finance function. Derivatives provide liquidity, price discovery, hedging tools, risk transfer. The system depends on them, but the volume has grown beyond any connection to real economic activity, beyond any justification based on hedging needs. It's become speculation layered on speculation, leveraged, opaque, systemic. And the regulators know this, the BIS knows, the Fed knows, the Treasury knows, and they're terrified but powerless because unwinding 6 trillion in derivatives would collapse the system faster than leaving them in place. It's a trap with no exit except waiting for the next crisis and hoping the bailout tools still work when the losses are even larger than last time. If this is revealed that 600 trillion in derivatives sits on bank balance sheets, that five banks hold 95%, that they're counterparties to each other, that regulators can't map the exposure that 2008 happened with half this amount, that nothing fundamentally changed, then you understand the next crisis isn't a possibility, it's a certainty. Subscribe now because the next investigation reveals the trigger. What event, what shock, what default starts the unraveling? Whether it's sovereign debt, commercial real estate, corporate bonds, or something nobody's watching. The derivatives market amplifies everything, turns problems into catastrophes, turns losses into contagion, turns isolated failures into systemic collapse. And the banks pray you never learn this, never understand how fragile the system is, how leveraged, how exposed, because the moment enough people understand, confidence breaks, and confidence is all that holds this together, not capital, not regulation, not oversight, just belief that the system works, that banks are solid, that derivatives are hedges, not time bombs. And belief is fragile, especially when it's based on lies.